Hi, this is Randy Finney with Right Side of the Chart, and today is Sunday, February 28th, 2016. In this video, we'll take a look at several things. There's quite a bit going on in the market right now, a lot that I see. And what I wanted to do is start out real quickly, touch on the trend indicators. Then we'll dive into or just take a brief look at the daily charts, price action, moving averages on the daily time frames, and some developments that I've noticed on the 60-minute charts. And then I'll wrap it up. I think there's some very interesting or compelling developments. As I've pointed out some of those, but I'm going to cover a couple new things here today regarding sentiment in the market. So there's three different metrics we'll look at, and I'll give you my thoughts as to how I'm positioned and where I think we might be going, at least here in the very near term, and of course then the longer term too we'll touch on. All right, this is the quad trend indicator, I call it. I have from up there on the upper left-hand corner here, we'll start with this one. This is the monthly trend indicator, and this simply plots up top. The dotted black line is the S&P 500 going back, as long as you want to go back here. But in recent years, we'll zoom in a little bit, go back a couple decades. As I mentioned, this one's done a great job. The two lines up above, the blue and the red, are the 10 and 6 exponential moving average on the monthly time period. And that has defined bull and bear market, bull and bear trends. I've talked about this quite a bit in the past, so I won't do too much today. But I just wanted to confirm that, here we are heading into, the end of February, and, it looks like we're almost certain to get another confirmed sell signal or bearish signal with the EMA pair right here on the right. That histogram, that's just a custom histogram that represents where this pair is. So you can see a lot clearer with the histogram when the 6 EMA crosses below the 10 EMA, which it's done. And down here I use the ROC 12 sometimes, but I like the ROC 13 I've gone to in recent years, filtered out. Does a little bit better job of helping filter out the whipsaw signals. So back here you wouldn't have taken this signal because it wasn't confirmed by the ROC 13. But yet we can see we had back in January confirmed sell signals in both, and again looks like that will be the case after the markets close tomorrow, which of course gives us our monthly close. Again, when you use a monthly chart, monthly trend indicators, all that matters is how you close out that month. Anything in between could be a whipsaw signal. So that's clearly bearish. We'll look at just a couple others here. The NASDAQ composite. You can see confirmed sell signals there as well, confirming that we're most likely in a new primary downtrend. We'll do the NDX, NASDAQ 100. And that is the only holdout. I've mentioned this last month. That one is still yet to trigger either a bearish cross down in the ROC 13 or a bearish cross of the 10-6 pair. But that really is really a one-off there. And again, as I'd mentioned, the NASDAQ 100 is not a completely representative stock index. It only has 100 stocks, and of that, the top 10 make up over half of the NDX 100. So not very well balanced, and definitely not representative of the economy, as it's lacking certain key sectors. So here's the Wilshire 5000, which is probably the single most representative index. Clearly, now we're on our 1, 2, 3, third month. February will certainly close bearish trend. So this is a stock market right here, and that's bearish. And we can go down the line, look at IWM, small caps. They've been in a bear market for a while, and so forth. Okay, so by the longest term trend indicators, which is really the most important thing, every major diversified index in the U.S. is clearly, except the NASDAQ 100, which again is not a very diversified or representative index. So we really have most of the broad indices confirmed on that a new bearish trend is underway. In other words, a new bear market. Look at the weekly chart real quick. We'll touch on that. That is solidly, this uses a 1743 EMA pair, clearly in bear market territory. What's interesting too, if you look at this chart, and this is why we'll go here, if you're almost certainly you're going to see the weekly trend on a sell signal if you see the monthly trend indicator pair, especially after they both crossed over recently. Now look at this, the purple line is a 43 EMA. You can see it's done a pretty good job. This was in some of the U.S. indices, some of the small and mid caps, I believe, and the NASDAQ, if I'm not mistaken, actually had a bear market back here, a 20% drop at least by that metric. And you can see it's done a great job of defining bull and bear trends. This was at least the intermediate term trend, let's say, whether or not that was a bear market, which it wasn't in the S&P 500, but it was again in some other markets or indices. But if you look at it back here, it acted as support when tested from above, acted as resistance when tested from below there once the bear market was underway. Once again, another failure from below, and then boom, and this is when a new bull market was underway. We went under it briefly, got back up, and you can see then multiple tests right on or just below that line. Then we had a clear breakdown in late 2015. We tried to get above it, couldn't hold, so we're underneath it. So point is there is another trend indicator just alone, not even using the pair. The pair itself is defined here by the crossover and the, when the 17 is trading below the 43, this histogram is red. But what I'm looking at now is, since we've had this clear breakdown, and just like any other moving average, prices tend to only get away so far from a moving average before reverting back to the mean. In other words, let's just say that we're in a new bear market, which I assume that we are right now. We have just about all the evidence points that way. This is going to go a lot lower for a long time. I think this bear market will be slower, more prolonged, dragged out bear market than the last couple, but we'll see. We'll trade as it comes. My point being here is that we got very far away from that 17 EMA, or 43, I'm sorry, the purple line. And I wouldn't be surprised to see us come back soon and visit it. So the point of this video I'm making is there's contradicting evidence right now, both bullish and bearish, but I'm going to make the case that I still believe that the odds favor more upside in the coming weeks here. So I remain, as I've said for the last couple of weeks, cautiously bullish. And for those of you that have followed me for a long time, I love to short stocks. I'm just as comfortable shorting as going long, and I just don't want to be short too early. The thing about shorting is your timing has to be much better than going long. When you're long, especially in a bull market, the market will bail you out if you're wrong. When you're short, you don't have to be wrong for a very long period of time, both when you get in, especially getting out too late. So, because the short squeezes, short covering rallies, and once stocks hit their support levels and begin to reverse, the bounce is very sharp. So right now I've yet to recycle back in short. I may very soon. I talked about in the trading room, I considered going home net short on over the weekend, but I decided not to do it, decided against it for reasons that I'll go over here. So anyways, that's one possibility, just looking for a back test or near back test of that level, even possibly an overshoot. You notice a lot of these tests, we just barely overshot it, and wouldn't surprise me to see us go there on the upside. So we could, looking at this, I would take the S&P above 2,000. Well, that line is falling. Right now it's around 2,000. So an overshoot of it could take us easily above 2,000, and that would just blow out a lot of this short interest that we have in the market right now, and I'll get to that in a second. So that is right now what I'd label as my most probable scenario. Now there is the whole trying to pick up nickels in front of a steamroller thing, because if the primary trend is down, which it is, and you're long or taking longs at this point or trading aggressively long, you are trying to pick up nickels in front of a steamroller, because this thing could turn and reverse at any minute. We don't have to go back to that level. We've already had a nice bounce. We've reset a lot of the certainly the near-term oversold level. So, which brings me to one other thing. I had a question put to me today. There's someone who follows a site, like most people, and he works a full-time job, doesn't have time to do the active trading stuff, a lot of the things we're doing in the trading room, and just really wants to position for the next move down, the next primary move down if we are in a new bear market. And I think we're coming up at the point where, let's say you manage a 401k or any long-term funds and you've been fully invested, and at this point it's finally sinking in that, hey, we probably are in a bear market. A lot of evidence is just pointing that way. This is a great second chance. You didn't want to, as I said back here, I was long at this point on both these dips and bullish, and you didn't want to go short there. You'd be squeezed to, almost, it depends on your risk tolerance, but you'd probably be squeezed out by now. However, we've had a nice bounce, and from here to here, that's limited upside. So looking at just from a longer term point of view, and I'll get to this in the charts in a second, where I see this rally likely stopping. This is one level, give or take around that 43-week EMA. But so you could certainly begin now, if you were in a 401k or had long-term funds, start unwinding, take profits on those long positions. Yeah, you're not going to get at this level again. I don't think you will. It's possible. But at least you're not selling right here. You've recouped quite a bit of those losses in the last couple of weeks, even the last few months, and we could go higher. So one plan might be to begin reducing, at this point, either reducing long exposure, to book profits on the positions that you have some gains, or for whatever reason, just don't hold on to a loser. You don't have to have gains in a long to sell it if you think the market's going lower. But you could start reducing that exposure, and you could also start scaling in short. Now, you could reduce long exposure up to this level, maybe hold out for a little more, and then begin scaling in short. And again, I'll talk on some levels, but that lines up about what I'm looking at on the S&P anyways, around that 2,000 point level. And that's where you would begin to scale into short positions for the next leg down. So that is really from a longer term perspective. And again, a lot of what I do in the trading room is more active trading, as well as there's plenty of longer term trade ideas posted in there as well. You just have to sort through it, and a lot of people don't have the time for that. Okay, back to the quad trends. That was my weekly trend indicator with the 1417 EMA. This is a daily trend indicator, defines the intermediate term trend. These are longer term trends up top. This is the intermediate term trend, which is still clearly bearish. You can see here the red, the histogram. But let's not spend any time on that. I've covered these quite a bit in the past. Let's look now at the short term trend. Okay, this is a daily chart of the S&P 500, the black lines, the dotted black lines of the S&P. And there's three things that I'm using here on this particular trend indicator. One which is very simple and highly, well, I wouldn't say highly, but somewhat effective, is the 20-day EMA. Simply, when prices are above the 20-day EMA, as they are here, the 20-day EMA is this blue line, the near-term trend is bullish, and more importantly, when the 20-day EMA is pointing up. In other words, when the slope is positive. If you have a negative slope, the line is pointing down or moving lower. So we have both prices above the 20-day EMA and prices moving up. If you're looking at this chart and saying, well, wow, Randy, the prices just slashed right through. Yes, this is a trading range. This is when you want to get away from your trend indicators. When you see this kind of choppy sideways price action, such as we had pretty much throughout 2015, and you see these are trend indicators whipping, going from bullish, bearish, don't trade off trend indicators. This is when trend indicators work. Again, these histograms just show the difference between the EMA pairs. 13, I have a 39.13 and a 26.13 over here. And when you have these large differences, well pronounced, large spread between the two, that's when those trend indicators become effective. So this told you, even though you're coming out of a whippy period, now if you take everything into context like I do, I don't trade off trend indicators alone. I pointed out this was and it was shown better on the daily, on the candlestick chart. This was that trading range we were in and broke out of in early January, and that was the sell signal. And I pointed that out on the site, both the S&P 500 as well as the Qs. We broke out of that trading range, and we were given a gift, a perfect, nice little back test of that range, especially on the Qs, and then boom. So that's where I had pointed out, we already had TQQQ on as a short throughout that trading range, and that was the last real objective entry right there on that breakdown. So again, and the trend indicator just confirmed, stay in it, and then at this point, the trend indicator went bullish, rained bullish. It's bearish, but now what I wanted to point out is, look what's happened. We just crossed over here on the S&P 500, and both these trend indicators are now positive. Hard to make it out there. You can see the positive numbers, 1.22 and a little green bar. And we're coming off that extended sell signal reading. So this is less likely to be a whipsaw signal as these were back here. You can see when you have these large mountains or hills, if you will, the signals tend to last a little bit longer. So that's just one thing, again, pointing towards the possibility that we might see a little more upside here. And I would not in any way be surprised that we go up to that 2,000 level. You just have to be cautious, again, when you're trading on the long side. bullish sell signals, I'm sorry, bullish buy signals, trend indicators, bullish chart patterns have a much higher failure rate, and those that do play out tend to fall shy of their projected target. So that's why I continue to use the word cautiously bullish right now. Okay, enough of the trend indicators. Let's jump into the charts. I'll touch on these lightly quick. These are two important developments, but I won't spend too much time. And then I do want to spend the remainder of the video looking at the sentiment indicators because there's some very compelling developments there recently. This is the S&P 500 on a daily time frame. We're looking at a candlestick chart. This is what I've pointed out recently on the site, and this is what has kept that near-term bullish bias. We had a strong, clear bullish divergence. In other words, positive divergence. Here's the MACD, RSI, prices making lower low against the indicators making a higher high. Now, even in a bear market, I give a lot of weighting into positive divergence all the way out on the daily time frame. 5-minute charts, 15-minute charts, they may play out, they may not. They have a higher failure rate. So far, this has played out very nice. So the question is that the extent of it? We're coming up. Both of these lines I have here are resistance lines that I see is pretty decent resistance. This is that target. There's that 2000 level. This is another thing to look at here. This chart, TC2000 has a problem. They don't populate the EMAs. They use the number of candlesticks on that chart. So you can't see it going back here. Maybe I'll pull up another chart from stock charts here in a minute. But you can look. The 200-day moving average also is a key moving average, and it often, when tested from above or below, produces reactions. Again, you won't see it here because it's only showing you 1 year, just over a year of that line, the red line there. And that also comes in around the 2000 level, just like that 43-week EMA that I pointed out a while ago. So this looks like a magnet here. If we get much above, as I mentioned, we just recently, looks like that breakout of that W pattern, it's really failed. We closed right about on it on Friday, so it's bulls can't declare victory yet. But if we continue to move up next week, and if we get over Friday's highs, I think there's a good shot that we're going to go up. And once we get up to that 2000 level, the momentum, we could easily overshoot it. When there's very well watched resistance levels like the 2000 level and the 200-day moving average, the market doesn't give the masses what they want. If there's so many eyes on that level, you're probably going to either fall short of it or you're going to overshoot it. And I'm leaning slightly towards an overshoot in this case, to be honest with you. But let's see what's giving me pause here. Yes, I said the word but. I hate contradictory analysis because it does you no good, but I have to share what I'm seeing. And again, this is why I'm cautiously bullish, because I am seeing mixed signals. Here's 60-minute divergence. I also mentioned even in downtrends like we've been in, like I went low here, I went long there, I went long here. We had positive divergence here on the 60-minute chart. I mentioned it here. I didn't have it drawn out on this particular chart. You see this divergent low back there? Well, that produced this bounce. There's bullish divergence on the 60-minute chart, just like we had back here. You can draw them out. You can see they're on every one of these indicators down here. So that bullish divergence has played out. Now, however, we see this line that looks like the MACD is poised to cross on any more downside, and that will confirm that negative divergence. I like to see the MACD cross over, make a bearish cross to confirm this. Right now, we have potential divergence with the prices making higher highs, and I kind of drew it within this wedge pattern here defined by this line and this line. So this is, again, what's giving me pause here. This 60-minute divergence could play out for a considerable move down, and if so, that may be the end. This could mark the end of the move up off the February February 11th lows. So something to watch, and again, next week will be very telling. You can see this blue trend line here. Let's go back a little longer. You look at all these reactions here, there. So we've broken above that. That's bullish. That's a breakout, and looks like we might come in and back test that level. So like I said, guys, mixed signals, but taking everything that I'm looking at so far and what I'm about to get to, I'm still leaning towards that bullish side. In other words, I am not pressing the longs hard. I do have mostly longs in my account right now. I am waiting for the time where I think it's right to start aggressively scaling back in short. And I might miss the top on this one, and that's fine, but I'd rather miss the top and get it on the way down, because there's plenty of downside left on the next leg down, I believe, than to get in too early and just be watching my account, my profits whittle away over the next 2 or 3 weeks if that's what it takes to get up there. There's the NDX, NASDAQ 100, same divergent high. Should have had this drawn out for you already. You can see the negative divergences. I'm drawing it here. On the first was the MACD, then the RSI. This is just one of my trend indicators on a 60-minute chart, the 1333 EMA pair. So we had a divergent low back here, and now we have a divergent high within what could be a bearish rising wedge pattern. We only have 2 tags. I'd like to see another reaction off there. Let's see how prices handle that. And we could come back in. You know, the Qs, I mentioned the SPY tried to break out of that trading range. The Qs need to take out this line here. I should probably highlight that, edit that line, make it a different color. And there's actually a reaction even a little higher up there. So I would put that right about there. So the Qs need to take out, just like the SPY does, they need to take out those highs they put in Friday, and that would be bullish. But be careful, because this divergent high is in place. Maybe this divergence gets burned through. And what I mean by that is this MACD curls up, moves up, and goes on to take out this previous high. That's what I use the term negating the negative divergence, if you will, because it negated what was forming. So something to watch for. And if we do break it, then this is a bearish rising wedge pattern with the primary trend being down. So, you know, measured target, you take a bearish rising wedge pattern, draw the distance of the highest point of the wedge, like I did here, and you add that. I like to add them to where they break down, especially in the primary trend. Some people add them on top, but I like to add wherever it breaks down. So that could bring us down lower. And as I keep saying, I think if we get down near these lows, the next time we visit these lows from back in early February, we're probably going to keep going and break down and have the next major thrust. So if this thing happens to play out and we get much below this line here, the let's say 4,000 level on the NDX, markets could be in trouble. There's NDX from the daily chart. I don't have too much here. You know, bigger picture, this is a trend line off the 2009 lows. So we broke down, and this is, again, the bigger picture. Breakdown, back test. But here's that bullish divergence as well on the NDX, the NASDAQ 100. There's the 200-day moving average. So again, I wouldn't be surprised for us to test that. You can see we challenged it here, failed once, then broke above it. But this is a level, this would be my ultimate bounce target. This is where I would be getting aggressively short if and when we get here around the 4,500 level on the NDX. There's a couple gaps. I just think that's a optimal target. And again, I don't think if we get all the way there, I'd be surprised. So I'll more than likely begin scaling as we approach that, and I won't wait for an exact hit of that. And there's a gap above it we might take out and go all the way up to here to 4590, call it 4600. If we get much above there, then I'll have to rethink the whole new bear market thing. Okay, now we get into the good stuff. I mean, this is all good, and again, I take everything in together, charts, moving averages, and then this is one of the things, and I've talked on this in a few different aspects of sentiment. There's different ways to measure sentiment. One of those, and this is pure and raw. There's surveys, and that's people telling you one thing, and how accurate those surveys are. That's usually those things do work out only when they hit extremes. I only pay attention to market sentiment when it is at extremes. Never try to extrapolate anything when it's in between, and I'll talk on that in a second. Now, this is the directly from the NASDAQ's website, NASDAQtrader.com. This is a NASDAQ short interest, and I just picked the Qs here. I can't go over too many stocks or ETFs with keeping this video as short as I want to. Let's just look at what I would like to highlight here. Here's the recent short interest. Now, keep in mind, I should make clear, this short interest, for those of you not familiar, the data is only released bi-monthly, so twice a month they come out with the short interest, and even then it's lagged by up to 3 weeks, meaning they have a 2-week, they report it twice a month, but I think it's about 10 days or so after the reporting date, before the dissemination date, in other words, when that data is released. So we're not going to get the next short interest, which will come, it should be out here soon. You can see there's the end of January. This is mid-February, so we'll have the tomorrow's data actually be February 29th, and that will probably come out, after the first week of March. So we won't know, but I can tell you from just knowing how bearish everybody was recently, I wouldn't be surprised to see that number go even higher. Okay, why did I highlight that? Well, let's take a look. We're going back. This chart shows us for the last year. Let's scroll down a little bit. Okay, I tried to move my screen. I had the screen capture software set up on just a portion of my screen, and I can't move it up any higher. I can't move this window. So there's a couple months cut off down here on the bottom, but I can tell you just below what you can see here, March 31st, 40,000. Below that it was 39, and then 47,000. So what I wanted to highlight again, the recent readings, which have probably gone higher since then. We'll know that in a couple weeks or about a week and a half. And then the only other time you've seen this short interest, over 70,000 shares, 71,000, almost 72. It was identical back here to September 15th. You can see before that 40,000, 40 in the 40s, 30s, and all of a sudden it ramped up. Short interest covered. Then you had a lot of short interest ramping up. What happens is shorts, the majority of shorts are reactive. They don't get in front of these big moves. They start shorting into a move once it's already happened. And unfortunately for the masses, most of the retail traders, even a lot of the institutions get caught right at the lows, and that's what happens. And they get blown out. And that is the beauty of a bear market. I love shorting stocks in a bear market. Prices fall faster than they rise, and I absolutely love playing bear market rallies because they shoot up faster than just about any bull market rally you have. And that's because it's those. You have a combination of natural buyers stepping in, people thinking, okay, valuations are good, there's my favorite stock, the selling is over, I can step in, and you have the shorts covering, being squeezed out. So that's what I'm looking at here. So there's a bullish signal number one, is that short interest reached a level. Now let's get to what I was talking about here. So that was the what was it? September 15th. Okay, where was the market on September 15th? That's back here. Look at the crosshairs. So here we were, September 15th, right about this point. So right before we had one last leg and this huge thrust up. So again, you don't want to be getting short when the market is reaching extremes, because then you're likely to get caught in a short squeeze. And look at that. When I tell you how fast this wasn't just all natural buying. In fact, this was institutional distribution up here. This was a lot of shorts that got squeezed out at that point. More than likely, that's why you see that fast move up. And so far, that's the case here. So again, that's reason number one. We just need to let all that short interest clear out, and it may not be over with. Okay, so that was sentiment reason number one. Too many shorts in the market. Everybody's bearish. Those shorts, that short interest needs to not completely be cleared out, but more than likely you'll probably see a little more short covering there before all said and done, and then we'll have another good entry. Now this is the CPC, the put to call ratio. This is a chart I've covered quite a bit recently, so I won't spend all the time. It marked the red line down here, marked bottoms. In other words, when you have extreme bullishness, that's when you hit this red line, which is my sell signal. You get down there, everybody's buying calls because they're all bullish, nobody wants puts, and what happens is the market tends to fall. Everyone's buying calls, nobody wants puts, and that's usually when the market top. So you can see I highlighted in the past those drops. I pointed out these readings back here, and this was what I call a double tap, when you have two readings in close order, actually three consecutive readings. That's a triple tap. I should put another blue arrow there, but we move down and then we move down again. So this is really, and it's not over, but that is so far the repercussions of those extreme bullish sentiment measures back there, as measured by this metric here, the CPC. And now I added this line up here on top. All the black dotted lines, just you can line it up, mark where those extreme bearish sentiment readings came in. We had one recently right here I pointed out, and again you can just freeze the video, look at this chart yourself, but you can see in every case after these lines, this was a double tap reading right here. We had rallies. Sometimes those rallies came right away, sometimes like right here You can see we had the tag of that level. It's about the 149 level on the CPC. We had a little bounce, and then the bottom came a couple weeks later, and then a pretty decent rally, actually more than a decent rally. You got this whole thing here. There was your reading there. The bottom came a few weeks later, and then we had this move. Now, keep in mind, these were monster moves. So if you go from these black lines, that are marking up the tags up here, you're seeing huge runs because that was a bull market, and you would expect that. But this goes back in time. It even worked in the bear markets. You get to that level, and rallies come. There's another one there. There was one right here. We had this sell-off, and boom. So again, I pointed this out a couple weeks ago. Now we have right here, you can see, just like the other times, some of those other times, a few weeks later, like right here, there was the tag up here, measured by this dotted line. The bottom was about a double bottom a few weeks later and a strong rally. We had that level there, a little sputter step, another marginal new low. So this tells me, and this stuff has to be cleared out. You can't have everybody owning puts and making money. At least the institutions don't allow it. And it's also the dynamics of the market. You have all that. There's certain positions have to be covered and things like that. So I won't get into the nuances of it. The facts are there. So look at that chart. So and again, this is a sentiment measure. Everybody's buying puts. They're bullish. And that's what happens when you get up to this line. Not everybody, but the majority. There's the ratio. Okay, and finally we'll wrap it up with this one. This is one of my favorites. I've had a link forever on the front page to the AAII sentiment survey, which just polls investors on whether they're bullish or bearish. So when you click on there, you'll see, the most recent readings, and we've had some extreme bullish and bearish readings. So I'm going to right now show you the longer term charts, something that I think is very compelling. And again, another reason that's giving me pause on the short side, even though the longer term trend is currently bearish. Okay, what this is a spreadsheet. I downloaded the long term historical data of the AAII survey. And you can see here, we're going to focus on this bull-bear spread right here. The bull-bear spread is basically, they take the survey, and you have over here 25% of the bears bullish, 25 bearish. So you have, in that point, a spread of 0-2 because you had almost an equal number of bullish and bearish. As I said before, with sentiment measures, sentiment surveys, I should say, I only pay attention, just like with the CPC, for example, that one as well, only when it's at extremes. Anything else to me between the extreme ends of the range is just noise. And from my experience, you're not likely to get any useful signals or interpretation of where the market might be heading. Okay, I had to pause the video. It took me a while. I had a snafu with my spreadsheet. So if you look to the right here, right of the screen, this is the bull-bear spread. So what I've done is I've highlighted, I've always used readings of 20% or greater as buy signals. I should say negative 20%, and 20% or greater as sell signals. So in other words, what we're looking at here is I've highlighted all the readings that are negative 20% or more, meaning that you have a net difference of over 20% or more bearish than bullish. So if you had a 50% reading, 50% of the traders were bearish and only 20% were bullish, then you'd have a 30% difference there. So what I also did is I have an extreme of negative 30 or more. So right now, what I've done, and this is how I've used this. I've used this in the past, talked about this. I pay attention primarily to clusters of readings if they're on that lower end. So in other words, the light green that we're looking at here, here's a cluster of 3 readings in close proximity, and the last coming on February 11th. And that is right about here. If you look at the arrow on the chart, you can see here, that's, if I can get it there it is, February 12th. So when that spike low came, that's when that first reading was. The last reading, the most recent. This other cluster here, I don't show it. I had it marked here. I thought I had another arrow. See that other spike low? When we had the lows, you can see here, January 21st. That was at extreme. So there you had a pair, and really this is a trio since they're in close proximity, so that's why I left the one arrow there. That other one would be so close. Now, what does that mean? Why am I looking at that? Let's go back in time. The red, you can freeze this chart as you want. You'll see that those usually marked highs. That's when everybody became too bullish, when it's the difference is 20% or more. There's 20% or more bulls over bears. Those are obviously, this came around the market top back in well, here's 2015. Market topped a few months later. But what we're looking at right now are the extreme bearish conditions. So this is the last of the 3 sentiment measures. Now in dark green, when you see the dark green and bold, those are the readings over 30% or more. Those on standalone readings, these are very rare to see a spread of over 30% more bears, in other words, negative 30% or higher. And this was also a cluster, if you will, because you also had a reading right after that of 21% or higher. So where was that? Again, we just went through here. I'm scrolling back in time. This is 2016, 2015. We didn't have a single green reading, meaning 20% or more, negative 20% or more spread, until all the way back in 2013. And at that point, we had a very extreme there, and we had a cluster with another 20% reading. That's right here. So you can see what the market did from that point. So what this is telling you is not to get short when everybody else is bearish. It doesn't end well. Given this was a bull market, so we'll get back to these bear market readings. We go back. There's a single reading. It was only above 20%, so I don't bother it. These were too far apart. They were single readings, came months apart, so we don't do anything there. Here's one, July 8th, an extreme of negative 36.1%. That's all the way back here. This arrow right here, mark that low. And you can, again, scrub these on your own chart. Go back. There's an extreme again, over 30%, dark green. That would have been this arrow right here. At the end of, came around the end of October. So the November 5th reading. There was a double tag right there, 2 readings in close proximity. And again, I didn't try to skew these numbers to make them work to my, to make it look good. What I'm trying to, the point I'm trying to impress here. These are clusters. This was the low. You guys remember the market bottom on March 6, 2009. Look at these readings. 3 of those extreme dark green readings, very rare. We even had a 50%. I don't think that's even heard of in history of this whole survey. So that marked the bottom there. And now, okay, so you might say, well, sure, Randy, that we were in a bull market. That was the bottom. We were in a bear market up until then. This just marked the bottom, this extreme pessimism. So again, from sentiment, from a contrary perspective, if everybody is bearish, which these green things indicate. I use green because when they're bearish, everyone's bearish. You want to be bullish. You go back January 1st. That's right here, I believe. This candlestick here. Yep. Nope. That's November. That came in November, and I have that one right here. So the January 1st reading would have been right here. Sorry, right there. And that's actually the one that I didn't put an arrow. That's right, because that one came and it did have a pop. Now these pops, it doesn't look like much. It's hard to really zoom in and cut this. You're still looking at about an 8% rally in the market. And going back here, this one was about a 24% rally. And then back here, you had a rally from peak to high. You have to zoom in a little bit here. From when that reading came, that was a 20% bear market rally. So you had bear market rallies in excess in some of these cases of 20% on these readings. And like I said, that one that came in early 2009 in January, that was about the one exception that didn't play out. Here was another cluster, September. There it is. The arrows gives me the date. That arrow is marked at October 3rd, which was right in the tail end of these readings here. July, here's a cluster of 5 different either readings below 20 or below negative 30%, and that was back in July of 2008. So that should be this arrow. Oh, we didn't cover this one right here. And again, don't underestimate the strength of these bear market rallies. I'm just using the measuring tool to get a rough measurement. That's about over 8% rally. This one was even higher. So again, Go back, and it's got them all here. You can replicate this chart yourself if you just go to that AAII survey, use a link on the homepage under Tools of the Trade, and you click Download Historical Data from 1987 to present, and that's what I did here. And I just used an Excel spreadsheet to highlight those colors. And again, these are all bear market readings, each and every one. The only one that was excluded is that one reading here in January we hit an extreme. Every other one played out for rallies ranging from, I think the lowest so far was 8%. And again, that's during the bear market. And there's a 15% rally right there. So that's where we're at today, folks. That's why I spent so much time going over that and talking about these extreme sentiment readings. So is this enough? What we've had so far, this bounce of about 8%, sure, that's on the minimum of what we saw back here. And this was a meltdown, mind you, too. And everybody had every reason to get out of the market. This one, I think the ship is slowly turning. This is like a tanker out in the ocean. Tankers don't turn on a dime. They take wide, long turns, and that's what this market top looks like. This was more of a I don't want to call it the 1999 top because that was leading straight up, but either way. So that's the thing, folks. So we have those sentiment extremes, and there's a good shot, and there's that 40-week moving average, which is a 200-day moving average, and that would be just an ideal place. We have some horizontal resistance there in that line, so maybe a little more push up. Maybe we turn around on a dime and melt down. Maybe that was all that we needed to see these sentiment extremes play out for that 8% or so rally off the recent lows. But I'm still leaning the other way. So if that changes, I will do my best to get some short trade deals out on the site. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.